Hello, James Dobson here, your friendly neighborhood realtor. I'm just bringing you my, August newsletter, or I guess the September newsletter, August stats, whatever you want to call it. I'm just going to shrink myself over here and jump right into it. I'm hoping to keep this one on the shorter side. So, first things first, I want to direct your attention to this. We can see Toronto Metro sales. We are below the 10-year average, but we have turned up from the month of July. And I want you to sort of keep an eye out for this pattern of a downtrend with an uptick. So again here, months of inventory, we were in a balanced market, and we've just ticked down back into a seller's market with 2.5 months of inventory, which historically is still low, but not very much. I think the 10-year average is around 3 to 4 months of inventory. And then we have sales to new listings, which is, of all the properties coming onto the market, how many of them are being sold? 53% of them. From a high of 120%, meaning we were selling more than we were getting, to now only selling half. We're in that balanced market, up from a buyer's market, which was down 40%. And I guess what I wanted to touch on here was the concept of a bull trap, which is outlined right here. So when you have a secular decline or incline, you're likely to have small counter trend moves. So in a downtrend, you could have a strong, very violent uptrend where price is oversold. So price has gone too low, essentially, and people are finding opportunity, and they all jump simultaneously, which can shoot the price up. Sometimes lack of liquidity is the reason. Sometimes it's just a ton of opportunity. We don't need to know, really. We just need to know that it's not likely a trend reversal at this stage. With the rates being so high and the fact that we've only seen the uptick for 1 month, and no retest of the lows, I'm not convinced that it's clear sailing from here, put it that way. All right, here we have prices. You can see that from the peak, we are still declining. However, the rate of decline is slowing, which is good. We sort of expected that. To sort of back that up, we are down 19% on average from the peak, but still up 1% year over year, right? Which, when you all things considered, not that crazy, even though this chart does look kind of scary, at least to me. All right. I'm not going to stay on this one too long because not really much we can do about it. I just like to mention it. Affordability is not good right now. And it's an average stat, so it's based off a lot of averages, which can sometimes skew reality because, as we all know, life is anything but average. But when people are spending, on average, 70% of their income on a mortgage payment, that's a bad sign. That's a red flag to me that something is going to break, because how long are people really willing to spend 70% of their income on housing alone? Is that even possible? I'd argue no. This is for the real estate investors out there. This is just resale condo cash flows are now negative if you are a fixed rate mortgage investor. Here is the longer term trend of fixed versus variable rates, and the gap. So with this most recent rate hike, the gap will close significantly. Okay. Here's an interesting take on real estate investment versus GIC. So Alex, the guy who writes this article, is comparing the cap rate of real estate, which is your net operating income versus your purchase price, divided by your purchase price, and compares that to a GIC or a bond. A GIC is similar to a bond, but it's more just like a high interest savings account. However, they're not super comparable for a few reasons. One, real estate has appreciation, which GICs do not. It's a cash account, right? You're not technically holding a real asset. It's just cash. 2, real estate you have some control over, right? You can decide to rent it out, not to rent it out. You can make improvements. You can do all these things that can increase the value of the real estate, whereas with the GIC, you have no control. However, you also have no risk, right? Because real estate prices, believe it or not, can go down. A lot of people would, if you've lived in Toronto for the past 20 years, sometimes it's easy to forget because for the past 40 years, we've been in a pretty strong bull market in real estate. And things are just now starting to not look as great. So just a reminder, it depends what your risk appetite is. You can compare them, but they are a little bit apples and oranges. Something to keep in mind. The condo sector, you can find some good deals in the condo sector. I will say it is underperforming resale. And that especially in Toronto, just because the number of condos is growing way faster than the number of homes in the metro Toronto area, which is like a more tight version, obviously, right? They're breaking down houses to build condos just because they're more dense. So buy land, buy dirt, as they would say. Change in price, single family detached versus condo. All right. For all my renters out there, it's not looking good. I mean, if you have a place, if you don't, prices are at an all-time high. And hopefully, if I scroll down a little bit here, you'll see rental months of inventory. And there's quite a few factors that play into this. And I just want to break it down. Three fast steps. 1, interest rates. Interest rates going up have pushed a lot of buyers to become renters. They just can't afford to buy anymore. As you saw, affordability, it's not great right now. Number 2, immigration and demographics. We let in a lot of people to the country, and about half of them come to the Greater Toronto area. And so most of them are not going to be buying the moment they come here. They're going to be renting most likely. So that puts more demand pressure on rentals. 3rd, losing my memory here. Cyclicality. So it's been very, very hard to find rentals recently just because we've had this sort of perfect storm of all these other factors. Luckily, as we go into the winter, usually things slow down a little bit. It's usually actually that September 1st mark where people go back to school that things start to slow down. And then, of course, in the winter, people don't like to be outside as much. And so just less happens generally. However, if we don't see an uptick in inventory, prices are going to remain high and competition is going to remain strong. So what we really need is more rental listings, right? This is Toronto Metro condo rental active listings. And you can see since November 2020, we went from 12,000 listings to 2,000 listings. That's insane. That must be like an 80% drop in condo rental inventory. All right. So this is actually really interesting. This is something I learned about 2 years ago, which was, during COVID. Single detached homes, the rent for those homes didn't really turn down during COVID. They made new highs during COVID, whereas condos made a high in 2019 and didn't reclaim it until just recently. And so this compares single family homes to condos and the rent premium of the house over the condo. And you can see that we're finally coming back down to our average, which just means that condos are, if we're looking at homes and condos, homes didn't come down, condos went up, which is, I'll say on that. All right, we're getting to the end here. The 2 last charts I want to show you are more macro related. The 10 and 2 year yield curve. So the 2-year and the 10-year bond, you take their yields and you subtract them. And when that chart inverts, it has something like a 90% success rate for predicting recessions. And as you can see, we are now negative 0.047 or negative 0.47. Not good. Not a good indication. And what is that? Okay. It took me forever to figure out what the hell this means, right? It's something that floats around in the financial community a lot. When the yield curve inverts, what it's telling you is that investors would rather be in a short-term investment than a long-term investment because they're forecasting that things will be bleak further into the future. And that's it, basically. So it's just the short-term outlook is stronger than the long-term outlook, and that typically will predict a recession. Now, it's not perfect, and it's not instant. So it's not like the moment this happens, we're going into a recession. It can lag up to 2 years sometimes. So just keep that in mind. But you can see, of course, we have the dot-com and the GFC right there. We touched it at COVID, but with all the COVID relief we got, it's like it never happened. And now I think we're getting what we were supposed to get 2 years ago. And the conclusion here, one last thing to just scare you a little bit. Household debt as a percentage of GDP. 108% of GDP. What does that mean? Why is that important? Well, first of all, we're one of the most indebted nations on the country. At least indebted citizens, I should say. And with rates, something almost probably more than tripling in the past few months, that is going to put a huge burden onto Canadian households to service that debt. Because if you can't pay it off right now, those interest payments are going to continue to increase and increase. And then what happens? Consumer spending retracts. Businesses start to lay off. People start to get fired. Our whole economy goes into recession. That's when the worst of it happens, which is probably, this is sounding very doom and gloom, and I know I have for the past 2 months, but that's probably another year away. I don't see us just inflation comes down, rates come back down, prices skyrocket in the next 6 months. I just don't see that happening realistically, and especially when the Fed in the US is sort of going for this soft landing. I kind of expect things to just continue to sort of grind lower and lower and lower. Inflation will eventually come down. We will hit a recession, and that's when they're going to lower rates. Well, I think we've technically already hit a recession, but the moment inflation is maybe sub 6%, I can see the government starting to really cut rates aggressively, which should be a huge relief for asset prices. And with that, I will bid you adieu. And again, if you have any questions or you just want to talk about it, feel free to reach out to me. All right. See you next time.